I thought that was incredibly helpful and insightful. Really appreciate that, Andres. We're moving on to our next presentation, which is, again, a sector presentation on the consumer. And I referenced this earlier today about underpenetrated consumption and those opportunities that we see in the region. Jeronimo Guzman, who covers the consumer, will actually lead us through a discussion. And then we are aided by Arcos Dorados, who has management here to provide us some insights. And as you all know, afterwards, we will be taking a short walk or potentially a short ride to visit one of their restaurants, which I think is going to be quite exciting. So welcome, Jeronimo.
All right. Good afternoon, everyone. My name is Jeronimo Guzman. I joined INCA about 2.5 years ago. I cover the consumer products, food and beverages, industrials, and restaurants sectors. Before INCA, I worked for 10 years at Morgan Stanley, doing Latin America equity research. Most recently as a senior analyst covering the food and beverage space. Before Morgan Stanley, I got my MBA at the Wharton School. And I also have a bachelor's degree in industrial engineering and economics from Northwestern University. And I'm originally from Colombia, born and raised in Bogota. So today, I wanted to give you an overview of what we see as an underpenetrated consumption sector in Latin America. We also have with us, following my overview, we have with us Iñaki Esnaola, the IR director, and Máximo Ayerza, the corporate treasurer at Arcos Dorados, who are going to give us an overview of the company, followed by Q&A. So let me start with a general snapshot of the consumer sector in Latin America. I think what I would say is the sector is really at the core of our investment philosophy at INCA, which is based on finding franchise businesses that have a domestic market focus and are exposed to the secular consumer growth story in the region. When you look at the relevance of the sector, it's about 22% of the MSCI index. It's the second biggest sector. And the contribution to our portfolio at 19% is similar to that. But I would say that is, in many ways, understated, given that this kind of theme of growing consumption really touches many sectors. I mean, it touches financials, telecoms, even cement, where about 60% of the demand comes from individuals. And as Efrain mentioned earlier, household consumption as a percentage of GDP in the region is high on average at 65% versus the world average at 58%. So it does over-index relative to other regions. Now, the other thing I wanted to talk about is some of the characteristics of companies in the sector. I think there's two main factors, two main characteristics. Number one is the brands. So what you see in the region is very strong global brands that are very well entrenched. Global brands such as McDonald's, Coca-Cola, Walmart, that have a very strong position in the region. But you also see local brands that are competing head-to-head against these brands. Examples of this, or one example of this would be in the beer space, where you see pretty much across most markets, the local competitor is really the one that has the strong leadership position, whether it's Corona in Mexico, Brahma and Skol in Brazil, or as you may have already noticed, Quilmes in Argentina. And you also see it in food. You have very strong global, local or regional brands, such as BRFs, Sagia, processed food brands, Bimbo Bread, Mission Tortillas, Lala Milk. These are very strong brands that can compete against the multinationals. And the other element is distribution. So what we see is a very fragmented retail channel with high informality. Formal retail penetration in Latin America is still low. It's below 50%. And as a result, distribution becomes a key competitive advantage and a key capability of companies in the sector. One example to put this into perspective is soft drinks. So what we see in soft drinks is that 3/4 of the sales are done through traditional kind of small mom and pop stores. And this compares to the US, where 90% of the sales are done through the modern channel, so the big grocery chains. And just to put it into perspective, Coca-Cola FEMSA, which is the largest bottler in Latin America, it serves a territory that has 80% of the population in the US, but it reaches, through its distribution, 5 times the points of sale that the bottlers in the US, the Coke bottlers in the US reach. So that just kind of highlights how important the distribution is. Now, let me talk a little bit about what we see as the opportunity in consumption per capita. So what we see is a big gap in the consumption per capita in LATAM in the light blue versus the more developed market benchmarks in the darker blue. And the big difference comes from this difference in GDP per capita. So as you would expect, with stronger economic growth, you should continue to see this consumption growth playing out. And that's actually what we're seeing. So what we've seen in the last 18 years is this cumulative growth of 68% in household consumption in Latin America versus much lower levels of 50% in North America, 26% in Europe. And what we think is that this can continue. So we see a lot of tailwinds for the consumption growth. A couple that I'll mention are, number one, the demographic dividend. So this is what you see in this chart over here. Basically, as Efrain had mentioned, the population in Latin America is still relatively young. So about 40% of the population is under the age of 25. And what we see as a result of that is that the working age population as a percentage of the total population should continue increasing in Latin America versus other markets like North America and Europe, where we see pretty much the opposite, a decline over the next 20 years. Another driver is female participation in the workforce. What we see here is that back in 1990, female participation was around 40%. Now, fast forward to now, it's above 50%. So we're seeing this higher female participation as well, driving higher incomes, which should result in higher consumption. And this is what it leads to, these higher incomes. We're seeing the middle class population continuing to grow. So Efrain had mentioned over the last 10 years, we've seen this big expansion in the middle class, people shifting from poverty into the middle class, and the expectations are for this to continue. So with the projections for over the next 15 years, middle class growing in Latin America ahead of more developed market benchmarks. And I think what's important is to try to think about what that means for consumption. So there's a lot more people in the middle class. What are they going to buy? And here, as you would expect, pretty much across the board, middle-income consumers or households have more disposable income. They're going to spend more. But what they're spending their money on really varies by category. So what we really see is that there's some more discretionary categories that tend to have a higher multiplier. Categories such as people buying their own vehicles, education, recreation, food consumed outside the home. So you see more of a focus or more of a benefit in industries that are more discretionary, or industries where you see more of an element of convenience, let's say. And just to bring it more to something more specific, I wanted to talk about a couple examples where we're seeing this penetration playing out. The first one is the car rental sector in Brazil. So this is a sector that we followed very closely at INCA. Since 2008, we've had a position in Localiza, which is the largest car rental company in Brazil. And what we like about Localiza is that it has a very strong growth potential, and that's driven by the combination of a very low penetration of the market and the opportunity for consolidation. And let me talk a little bit about that. So on the penetration side, what we see is that vehicles per 1,000 inhabitants in Brazil is still very low, 1.9. And you look at the comparison is benchmarks like more developed markets, anywhere between 3.3 and 6.8. And what we see when we go to the region, we talk to the companies in the sector, and we see the operations, is that there's many different segments where this is playing out. So a couple examples are the individual and leisure segment, where what we see is that as the economies grow, there should be more travel by individuals. Right now, there's on average, Brazilian consumers do 0.5 trips per capita. And you look at more developed markets like the US and UK, that's 2.5 to 3 times. So you should continue seeing that developing with better economic growth. Another example is the corporate segment. So in Brazil, the corporate fleet is still very much owned. So only 9% of the corporate fleet is outsourced or leased. 9%, which compares to levels as high as 60% in Europe. So we see a lot of opportunity for that to continue as the consumers and the corporates get more educated about the benefits of renting cars versus owning them. And the other factor that I think is important related to penetration is what the car rental companies are doing to increase that penetration. And there, I think there's the element of affordability. So what's happened in Brazil is that as the companies have gotten bigger and more efficient, they've been able to translate a lot of those savings into lower rates at the same time as incomes are rising. So what we've seen, one interesting statistic, is when you look at the average daily rental rate as a percentage of the minimum wage in Brazil, that has gone from 38% in 2001 to 8% more recently. So there's a lot more affordability that should help continue increasing that rental car penetration. And then in terms of consolidation, I mean, the chart here just shows it very clearly. The top 3 players have 55% share of the market, and that compares to 94% in the US. And we think that will continue playing out, that consolidation, kind of getting closer to where the US is, given the advantages of scale in this business. Scale, which matters in terms of having the volumes to be able to get the best discounts from the automakers, which is your main asset. Scale in terms of having the volumes also to leverage the fixed costs associated with running all these rental branches, and also having the lowest cost of financing. And we think that, as I mentioned, Localiza is the best position to benefit from this, just given that they're the biggest player, but also the one with the longest track record of execution. Now, the other example is fast food in the region, in Latin America. What we see is that there's an opportunity in terms of 2 items. So one is fast food penetration as a percentage of total food service in the region. What we see is that in the markets in Latin America, fast food is only 21 to 27% of total food service, versus levels as high as 48% in the US. And we think that this trend will continue towards fast food becoming more important in Latin America as you have higher disposable income, but also as you have other demographic trends. You've got more urbanization, and you also have smaller households on average. So you've got busier households with more money. They're going to place more of a premium on convenience, and that should drive a higher spend on fast food. The other element is the formalization of the sector. So even within fast food, what we see is that chained fast food is still very low. So in Brazil and Mexico, you're talking about the chains, the more formal competitors, accounting for about 30% of the space, versus levels that are more than double that in other markets. Now here you're talking about players, the informal players that they're up against, is kind of what you see when you walk around pretty much any city in Latin America. So some examples of that would be in Brazil, when you're walking down the streets and you see the lanchonettes, which are kind of small establishments serving quick lunches for the Brazilian working class, usually a hot lunch with a counter and some savory snacks. Or in Mexico, where you see taco stands pretty much everywhere, and you also see fondas, which are family-owned restaurants that serve food to low to middle income consumers. The big difference here is that when you see the chained fast food offering, it tends to be a better quality product with a very compelling atmosphere, which we'll see in some of the store visits, or the restaurant visits, but also at a very attractive price point. So this should continue to play out, and I think the other thing that's important to think about is that this growth in the chained restaurants doesn't have to come at the expense of each other. So there's a lot of room to be gained from the informal competition. And more specifically, Arcos Dorados, we think, is the best positioned company to benefit from this. So Arcos Dorados is the master franchisee for Latin America for McDonald's. It's a company that we know very well. I personally was involved in the company's IPO in 2011 when I was at Morgan Stanley. And we also have a long history of covering it at INCA, most recently also in 2018 when we started a position in the company given this growth potential. And before I hand it over to the company, I think there's a couple things that I thought would be helpful to mention of why we like Arcos Dorados within the industry. Number one, I would say it's the brand, which translates into a dominant market share. Here you can see the market share relative to its main competitor, Burger King, across markets. And you can see a big gap between the two. And one thing to keep in mind when you look at this data is that it's not just about having more restaurants. So when you look at Brazil, for example, when you compare McDonald's to Burger King in Brazil, the sales per restaurant are about double. And this is really about traffic. So the products, I mean, the pricing is very similar. So it's about more people wanting to go to the McDonald's store, to McDonald's restaurants versus Burger King. And it's something we see when we go to the region and we visit the malls, we look at the food courts. There's always going to be a longer line at the McDonald's versus the Burger King because of a more compelling, a more complete value offering. And the other thing that's interesting when you look at market shares is that it's not just a factor of underpenetration. I mean, when you look at the US, you also see a very big gap. So McDonald's just has a very strong global brand that Arcos Dorados and other players can really benefit from and leverage in the region. Now, the other element is similar to what I mentioned in the past slide, which is when you look at McDonald's, when you look at Arcos Dorados, you can look at store densities versus the system. And what we see, again, is very similar. So store density meaning McDonald's units per million inhabitants. And it's very clear that the store density is still very low in Latin America. I mean, you see it ranging anywhere from like 2 to 5 versus levels in the system anywhere between 9 and, well, in the US at 43. So there's a lot of opportunity for growth. And with that, I guess this is a good moment to segue to Iñaki, who'll talk a little bit more about Arcos Dorados.